where the compression was not as much as what was feared. But for Kotak, they have taken that over 10, I think it's 11 basis points hit on the margin. So maybe it's just that 2% lower for the time being. Let's see if we can pull up SBI Card before we get to the rest of the Nifty. SBI Card is down 3.5% right now, 3.5%. Because remember, like Gaurav was explaining, while asset quality is improved, credit cost is improved, their revolver rate is still leaving a lot to be desired. You know, the net interest income has not risen as much as what the street would have wanted. So that's a stock that's under pressure. Anyway, the Nifty is charging ahead. So let's focus on the good. 70 points higher. SBI Life is a stock that's running away. Good numbers coming in. That's one that's reacting well. And the ferrous names like Tata Steel that Nigel was just talking about, 1.5% higher. There's Tata Consumer, there's the Shriram Finance, and it's the big boy itself. Reliance charging up the bulls this morning with a gain of about 1% thereabout. Even some of the tech names like HCL Tech, Tech Mahindra, all on the upside. So overall, it's looking good for the Nifty. The only stocks in the red, actually, Kotak Mahindra Bank, Reddy's is subdued after numbers. And Infosys seeing some profit taking. Remember, it was one of the biggest gainers last week.
Sorry, Infosys goes ex-dividend by 23 rupees. Yeah. So that explains the fall.
That explains the fall. But other than these 3-4 names, Kotak, Infosys and Reddy's, otherwise Nifty is looking good. 80 points higher.
Well, that's right. Let's focus on a few more names. Coforge, that's the stock of the morning, flying away up 5.5%. So that's the big result reaction from the broader markets. In the next 15 minutes, you'll have the management with us on the show. Vikran Engineering, that one won an order, so that stock is up close to 3.5%. SBI Life as well. Yash told us that those numbers look better than expected. The street was in position for it as well. So that's why that stock up and about in today's trading session. Saman Capital, well, that has moved into the F&O band. That stock is up close to 100%, but it's moving on large volumes. SAIL as well should come up for your screen because you have Tata Steel that's reacting to the upgrade. You have SAIL as well that's reacting a little bit positively, and SAIL as well has gone into the the F&O band. So that explains why that stock, in fact, is up and about. Cigniti is up close to around 6.5%. Remember, it's moving in step with Coforge. That's the new owner out there. They've been sounding quite positive on prospects as well in the integration. So 6.5% move on that particular name. All in all, a good start. Holding on to the start is going to be important. Last two trading sessions, we have come off 150 to 200 points from the high point of the day. So the bulls will like to sustain this big opening.
Well, Brigade Hotel Ventures, we were talking to the management earlier. They're talking about doubling their key count from 1,600 to 3,300 by FY30. That stock has opened out with a gain of nearly about 4%. eClerx too is reacting to a good set of numbers, plus there is that buyback, and eClerx has a positive star. We should pull up Latent View too. That also reacted to numbers. Numbers looked okay, but the stock, I think, is down close to about 2.5%. There is some news on Godrej Properties, so that's pushing the stock higher. NCC, more than 6,000 crore order win, 6,600 crore. NCC is gaining ground. On the way down, Bharat Rasayan has a 7% downtick. I think there is some board meet, bonus issue, etc. on Bharat Rasayan. And the other one is Zentech. Disappointing set of numbers. So Devyani points out the revenues are down 28% on a year-on-year basis. And the company says that Q2 performance was subdued because RFPs were delayed due to priority for Operation Sindoor emergency procurement. But the company goes on to say the long-term revenue visibility remains strong. But Q2 was weak with a decline of 28% in their top line. Other than that, you've got softness in some GK Energy. You've got Pace Digitech. This is also one of the recent listings. You've got SCI on the softer side. Ola Electric has given up some ground, but about 0.25% up on the Nifty and the Sensex. Not quite the roaring start that you had across the rest of Asia, but mid-cap's doing better, up half. On
the rest of Asia also has, so much of deal excitement going for it, right? Including some of those regional ASEAN markets at the end of the ASEAN summit. But nonetheless, I mean, the bulls are trying to hold their ground, 70 points higher. So it's not slipping, and that's good news. And that's what the market will hope for. Reliance is the big torchbearer, so to speak, along with big names like SBI and L&T. Some of these big boys are firm at the crease right now. So let's see. Decent start.
This Kotak Mahindra Bank, there is a JM Financial downgrade. And they say that given the 10% rally in the stock price in the last 1 month, the current standalone valuation is 2 times price to book. That's about a 10% discount to HDFC Bank and ICICI Bank. And therefore, based on the valuations, they are downgrading the stock to a reduced target price stays at 2,100.
Okay, all right. Let's then discuss banks and more with our next guest. Our market master of the day is Dheeraj Agarwal, Managing Director at Ambit Investment Managers. Dheeraj, great to have you with us. Hope you had a fantastic Diwali, and greetings of the new somewhat to you and your team.
Thank you so much.
That's the real question, right? Like in the absence, the moment this India-US trade deal comes through, we'll have a different conversation. But as of today, in the absence of that clarity, I mean, are earnings giving enough ammunition to the bulls to sustain above all-time highs and to decisively head higher from where we are?
Not at this moment, no. But the hope that the next quarter earnings will be significantly better is high because the festival season demand has been pretty robust, triggered by festival season itself, obviously, and the GST cut impact flowing through. So I hope that the December quarter earnings are significantly better than what we have seen in the last few quarters. And that will be very, very essential, as you rightly said, to keep the market sustained at a much higher level.
So, Dheeraj, let's talk about financials, right? Because that's where the excitement really is, whether it's numbers, whether it's deals. It's all about financials now, finally. First, let's talk on just purely on P&L, what you've seen from large lenders so far, or even large NBFCs. Like most point out, the margin compression has been lower than anticipated. Now, Kotak could be an exception, and therefore Kotak's kind of lower today. But what is your read-through looking at Q2 earnings so far and the commentary?
I think if you see Q2 earnings so far, barring either a small margin beat or a small margin slip, which I think is too much of micro analyzing, results have been by and large in line. So there are no big positive surprises, there are no big negative surprises. And once again, going forward, I would link financials to the strong festival demand that we have seen in the month of October. Indian financials are a lot more linked or leveraged now to consumer demand as compared to capex demand, right? Because everybody is growing the consumer book much faster than the industrial book or the corporate book. And hence, if the consumer uptake that we have seen in the last 1 month sustains, I think credit growth also picks up at least by 200 basis points. And that will be good news for financials too. So to sum it up, I am positively inclined towards financials.
What percentage of your portfolio will you allocate to financials, NBFCs, the capital marketplace?
Yes, NBFCs and financials for sure.
And what percentage of your portfolio?
Yes, I will be overweight, meaningfully overweight.
Meaningfully overweight. So if, banks account for what, 35% of the Nifty?
30%,
Approximately
31,
32%. So how high would you go?
That's a tricky one, but I personally am comfortable going up to 40, 42.
Oh, okay.
Yeah.
All right. Hi, Dheeraj. What about tech? How are you placed out there? You get the signals that are coming there, rather mixed. The next management as well, I request you to, tune into that conversation. We'll have Sudhir ji who will be talking about Coforge's numbers. And Coforge as well as Persistent have continued good growth. And that's why the street rewards them with good multiples. So how would you place yourself on tech, between the large cap, the smaller cap names, and what do you like?
So tech is a very, very bottom-up space at this point. So industry as a whole is struggling for growth. The industry as a whole, the growth is now at best mid-single digits, which doesn't make the outlook for the sector as a whole very exciting. Valuations haven't yet come down to, my benchmark is valuations have to come down to 2016-17 levels, and there's still another 20%, 25% low for the sector valuations to go to reach there, to say that even the current low growth is now fully discounted and one can now buy as a bargain buys. So tech is, you can't even differentiate tech into large, mid and small and bucketed saying mid and small is doing better than large. There are few individual names, as you rightly pointed out, which are continuously outperforming in the earnings, and markets are rewarding them with much higher multiples. But overall tech, I would continue to be cautious till such time valuations guess 2016-17 levels. That's my broad benchmark.
Okay, that's IT. Dheeraj, what else? What else are you studying, observing? Maybe don't have a straight-out buy as yet in this market. There are a lot of the new age plays as well, or plays that are quasi-linked to new technologies now, whether that's EV or whether that's data centers. Anything that catches your fancy?
So one clear space, we started the discussion with strong consumption demand, but we didn't discuss the consumption sector. So consumer discretionary with an element of premiumization. That is one clear space which I think should stand out. And again, I'm qualifying this slightly by saying one hopes that the December quarter numbers are strong and this momentum continues at least for a few quarters more. There is also an expectation that the 8th pay commission, once it comes into play next year, sometime mid of next year, will also help consumption. So, but more positive on discretionary as compared to staples. I mean, staples has its own challenges, and a little bit of price cut doesn't really move the demand needle for staples, but it does move for discretionary.
But discretionary, Dheeraj, allow me to ask you, because discretionary itself is a very wide umbrella. So, I mean, it could include alcobev companies, it could include jewelry companies, and so on and so forth. So, if you could kind of give us some more clues and hints, what part of consumer discretionary looks good to you?
So, I classify even automobiles, I mean, the personal use automobiles, not commercial vehicles, as discretionary consumption. So, that would be my number one bet, because automobiles, the price elasticity, the demand elasticity to price is reasonably high. And I would be surprised if demand growth does not pick up and sustain for a prolonged period of time. Once you go below that, then it's very, very individual, stock specific. I think jewelry should do well generally as a basket now that the gold price is trying to settle down at a slightly lower level as compared to the recent peak. Typical consumer behavior is when the gold price is rushing, they sort of hold back on jewelry purchases. When it cools off a little bit and settles down, the jewelry purchases come back. So jewelry could be another sector. Consumer durables, white goods, brown goods, those would. So the segments which are typically price sensitive, you know, air conditioner prices goes down by 10%. You say, chalo le lete hain, bahut din se postpone kiya hai. Same thing for cars, etc. So higher ticket consumption and more premiumization consumption as compared to lower ticket. I think that should pretty much classify where my thinking is.
Dheeraj, any initial thoughts on Lenskart? There is a press conference scheduled today. We know it's a very popular brand across age categories. The company has grown very fast. You know, as of FY25, the company's top line is 6,650 crore rupees. I mean, so it's grown fast. The only thing is, you know, when you look at the valuations, I think it's going to come up, you know, fairly steep. Trailing, it's more than 200 times. FY25 PE, I believe, is more than 200 times. Market cap will be 70,000 crore. I mean, have you any initial thoughts on this? Not a buy or sell, but considering it's a consumer company and that's a space you're interested in.
So it's seeing a very, very strong growth, right? So typically, any company which has that kind of a growth, we always find markets struggling to figure out what the right pricing is. So I think it should get a good response. I think it should do a good listing as well. How far the listing gains actually sustain will depend upon can they sustainably deliver the growth in the next 2 or 3 years. But typically, very high growth companies tend to get rewarded with excessive valuations in the market. So I think Lenskart falls in that category. They've executed really well. So on the whole, on the IPO itself, I'm positively biased, but let's see long term.
All right, Dheeraj, a quick word on renewable energy. I think that was the theme that you said has a bigger runway. You know, how do you approach it? Because there are various verticals, you know, whether you're going for solar, the different other types of energy, maybe another way of looking at it. So tell us more about this theme that you like, renewable energy.
So as a percentage of total energy consumption, renewables will keep going up. I mean, there is a clear government thrust, there is a clear need with respect to pollution, environment, and climate. And every company involved, I mean, including NBFC, which has historically been a thermal energy company, has been investing a lot in the renewable space. So the entire ecosystem within the renewable space, whether it is battery storage systems, panel makers, the energy companies itself, etc., will see a very strong business environment for the next 10 or 15 years. To convert that into stock picks is, however, a little bit more challenging. So, for example, if BESS takes off, the T&D investment required will be lesser than what we believe will happen at this point of time. So, one needs to take cognizance of that. There are lots of new emerging technologies which can disrupt linear thinking that this will require more T&D, hence just go ahead and buy T&D companies at any valuations. And the third that one needs to take cognizance of is many of the companies which are leveraged to renewable energy space are already trading at pretty steep valuations. And one of my observations in the market at this point of time is markets have become valuation sensitive. We have seen quite a few stocks, despite good growth, but valuations being steeply high, actually not performing in this market.
Dheeraj, always a pleasure chatting with you. Thank you very much for joining in. But do listen in to the next conversation. We've got the management of Coforge joining us on the show. It's a very strong performance. Revenue growth came in at 5.9%. Margins expanded to 14%, as has been the company's guidance. And they're talking about a robust H2 as well. Sudhir Singh, CEO of Coforge, will now be joining in. And some of the things that we'd like to discuss with him is what's driving this confidence about the second half of the year, the outlook on margins after the company's achieved 14%, and what beyond the $2 billion revenue run rate that the company had put out, because now it's within sight now. Sudhir, thank you very much for joining in. This is Reema here. Tell us about H2 and how you see it. You sounded very confident in the call, but because Q3 is a seasonally weak quarter, but you expect a bounce back in Q4. I mean, what are we looking at?
I think you put it very aptly. Q3 is a seasonally weak quarter. We believe the entire year, given what we've already logged at the end of H1, which is almost 26+% growth, is going to be an extremely robust year. There will be the usual moderation that happens in Q3, and then we would expect things to normalize in Q4. We expect, on the whole, fiscal year 26 to be a robust growth year for the firm, as we'd indicated at the beginning of this year as well.
And on margins, now you're talking about 14% margins at an aggregate basis for FY26. Is that correct?
That's absolutely right. And we, incidentally, you would have noticed this, we've logged in 14% EBIT in quarter two itself, which was almost 250 bips higher year on year. Our outlook for the full year again is 14% EBIT, and it's our intent to make sure that we get there.
Okay. And what will be the impact on account of wage hikes in Q3 on your margins? And you also spoke about how that beyond 14%, you don't plan to expand margins. The priority will be on growth. So take us through that too.
Right. Quarter three, we've already declared annual increments for the entire workforce effective the 1st of October. That's going to be a headwind. There are also tailwinds on the margin front because the ESOP cost is going to fall materially in quarter three again, just as it did, and just as it fell in quarter two. So quarter three, with the wage hikes, which will be a headwind, with the tailwind put together, we'll try to make sure that we turn in numbers that across quarter three and quarter four land us at the 14% that we need to land at.
All right. Hi, Sudhir. Good morning. Good to see you, Ben. Quick question. 80 basis point margin expansion is what we saw in the last quarter. How much of it was because of the rupee depreciation?
There was an element of the rupee depreciation in play, but the one thing that I do want to call out about our results is we also take our hedge losses and gains to the top line. We had a headwind of 78 bips because the hedge losses this quarter were higher. So we had headwinds of 78 bips because on account of the hedge losses higher than quarter one. We had a tailwind of 20 bips because ESOP costs were lower. In total, our net headwind was 58 basis points. And after that headwind, we have reached the 14% EBIT that we did call out for quarter two.
Okay, all right. So that's encouraging to hear then. You're already going at a run rate of around $1.8 billion approximately. You were talking about around $2 billion, right, in FY27 at some point of time. Is there a possibility next couple of quarters you move to that $500 million a quarter run rate, which in turn means that you've got to the $2 billion run rate?
Well, we don't give a revenue guidance, but obviously, as you can imagine, the intent is to get to the $2 billion run rate at the earliest. We believe, within sniffing distance of that $500 million per quarter, which is the $2 billion annualized run rate. The intent is to keep the feet on the pedal and to get to that at the earliest possible.
Sudhir, hi, great to have you with us on the show again. Investors pretty happy with the performance, and it's been so steady, right? I think another thing that the street is taking heart from is that this whole issue about the free cash flow and your investments and the whole confusion around the data center. That's a thing of the past. Correct me if I'm wrong, but the numbers that I have suggest that your free cash flow is back to about 37 million. So what is the guidance on the free cash flow and future investments, data center or otherwise? And just talk to us what this whole AI pivot will also mean, because I think you made a reference towards this even in the investor call. So tell us about some of this in the future investments.
Well, our free cash flow, you're right. Our free cash flow to PAT for the quarter was 86%. Our guidance on a go-forward basis is that it will be our intent to keep the free cash flow to PAT metric somewhere between 70 to 80% on an ongoing basis. As far as AI is concerned, we've always said this, and we continue to maintain this, that what has differentiated us and our performance over the last 4 years has been an execution intensity that is uniquely our own. We've always said this, execution is not just about sharing plans or strategies and sharing them in public. It's more about making sure that what you share actually gets done. There is no place which exemplifies this ability of Team Coforge to bring execution to life than in our ability to not just embrace AI in our internal operations, but also to be able to create our own IP, our own frameworks, which we have, which are the ones that are actually driving the transformation that we are seeing and the revenue uptick that we talk about. When you look at Coforge, Code Insight AI, which is our platform, is the platform that we're using for some of the largest reverse engineering pieces of work that we're doing with code right now. When you look at Forgex, we're using that platform, again, our platform to drive transformation at scale. And if you consider Blue Swan, which is our orchestration and automation AI-based platform, that again is driving it. So AI, for us, our ability to embrace it, our ability to bring it to life and not just talk about it.
No, absolutely. No, absolutely, Sudhir. And that is driving the kind of revenue momentum that we're seeing. But what I'm just trying to understand is that from an investment point of view, whether it's organic or inorganic, is there a specific AI/data center related additional investment that you see ahead on the horizon that you can call out?
Absolutely not. There's going to be no further AI data center related investment that the investors should expect. And we were very categorical about that in our investor call as well.
Sudhir, just to get back to the point about growth and margins. Now, you've said the focus will be on growth rather than pushing margins beyond 14%. But at what point will that change? Will it change when the company's top line hits $2 billion, as is the first goalpost? Or would you like it to, say, hit $3 billion before you will look to also simultaneously expand on margins? Because some of your peers are operating at higher margins.
Well, I wish to be very clear. We haven't said that the intent is not to move beyond 14%, but what we did say and what I did say at the beginning of this year was that our first goal for fiscal year 26 will be to hit an EBIT of 14%. We feel confident with that guidance at the current point in time because quarter 2 EBIT itself was 14%. Having said that, we believe that once the 14% EBIT baseline is secured, that's the minimum threshold by way of ambition that we will retain for us on the margin side. The primary imperative is going to be growth, if possible, industry-leading growth, as we clocked in FY25 and are likely to clock in FY26. EBIT will increase, but we aren't giving an EBIT increase guidance. As far as we are concerned, the pecking order is very clear. After we hit 14% EBIT, growth will be the primary imperative. EBIT, of course, given the operating scale-up that will happen, will continue to inch upwards.
All right, so the final couple of questions before we let you go. Why are the deal wins stuck at around $500 million? And now with Sabre fully ramped up, do you think there'll be a slowdown on deal wins? So you could give us some kind of color with regard to deal wins on a quarterly run rate. And also your interest cost, it's holding around 40 crores per quarter. I think your total debt in your books is around 650, 700 crores. Explain this to us because that's an annualized interest cost of around 160 crores. I'm guessing there'll be some stretched working capital there. Go ahead.
Sure. I think why only $500 million is somewhat uncharitable because we hit the $500 million benchmark very recently. If you go back 2 years, the firm used to clock an order intake on an average of $300 million. So over the last 2 years, that number has moved dramatically. 500 million is a number that we take a lot of pride in. The intent is to keep inching upwards, but at this point in time, if you look at the next 12 months signed order book of Coforge, that is 26.7% higher than where that signed order book was just a year back. So 500 million, the intent is to continue pushing it upwards. If you look at our large deals, even in Q2, we've signed 5 large deals. In the first half this year, we've signed 10 large deals, contrasted with 14 that we signed through all of last year. So our large deal velocity is going up. Large deal median size is going up. And I think it's a matter of time before the 500 becomes a 600 or a 700. But as always, we aren't giving a timeline or a forecast around that.
Okay, all right. And the interest cost, you just want to comment on that?
I wouldn't have the numbers handy with me, so I can't give you those numbers offhand.
Okay, all right. So, thanks a lot for joining in. Good quarter, sounding optimistic about the future as well. We'll track you to a few of these numbers that you've given us. Wishing you a good day ahead and a good quarter ahead as well.
Thanks very much.
Well, a quick note then for our viewers. As you can see on the screen, what's going to come up for you, there's a money control stock score just above the line graph. This is a score assigned to each stock based on Money Control's multi-factor algorithm. It's calculated by analyzing over 40 parameters, including both the current and the historical financial statements, the price charts, the technical indicators for each stock. Now, each of the individual parameters is considered for calculation of these 4 factors. They're assigned a score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or a sell recommendation. Any investor, viewer is advised to carry out the necessary diligence on their own or through a certified registered financial advisor for investment decisions. So take note of that. Well, time to slip into a short break, but up next we have Shweta of Elara Securities who will be joining in to talk about her expectations from the NBFC sector. Stay with us. Well, as promised, it's time for our special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from each sector. Today, NBFCs are on our radar, and Gaurav joins us to tell us what do we expect from that space. Over to you, Gaurav.
Well, yes, when we look at NBFC space, let's see how are the quarterly updates, and what's the landscape going ahead. So when we look at the quarterly updates, we have seen a quite mixed set so far. Retail focused NBFCs like Bajaj Finance and L&T Finance, they have reported healthy set of numbers on a year-on-year basis in terms of AUM growth. While on the other hand, M&M Finance, we saw a little bit of weakness. They reported around 13% growth in terms of the overall AUM. Now coming to the quarterly results expectations, when we head into second quarter, it is likely to be a tepid quarter for most of the NBFCs, but disbursement growth, that is expected to pick up, and this will be because of the asset quality front also. If we look at the challenges, they are likely to persist, but at the same time, we may see some kind of impact which will be offset by spread expansion. MSME and MFI, that is one thing that we should be watching out for, because here we may see some pressure to continue. But at the same time, when we look at the margins, they should get a lift, because this will be the first quarter where we will see the reflection of 100 basis point of repo rate cut completely. So that is something that we're expecting, that margins may actually increase. Now let's break it down in the segments. First, when we look at diversified financiers, now starting with this segment specifically, because we have seen already some of the updates coming up, and from here on it is likely to see that the disbursements, they are likely to pick up. Credit cost, that should stay steady, and at the same time, when we look at margins, we may see some kind of improvement in terms of margins. In fact, if we look at all these parameters, that is the reason why we've got some of the players who can expect profit to increase somewhere in the range of 12 to 30%. At the same time, when we look at credit costs, that is likely to remain contained, and that is the reason why ROAs, they are likely to remain stable for this quarter at least. When we move ahead to vehicle financiers, now AUM growth, that is likely to moderate, because if you look at Chola Investment, we have already seen they have cut down their growth guidance, and at the same time, if you look at the expectation, now Street is not expecting any kind of major growth, about 20% specifically in this sector. But when we look at the profitability, now that is still likely to stay strong, and this is because of the margin expansion from fixed rate vehicle loans. When we look at credit cost, that is something that we should be watching out for, because some of the brokerages, they expect credit cost to increase. In fact, when we look at some of the updates in likes of Kotak Mahindra Bank or some of the NBFCs, HDB Financial, we have already seen they are talking about retail CV and specifically some stress in CV segment. Now, second half, that could be better. That was because of the GST cuts improving demand and at the same time volume uptick. But for now, ROAs are likely to remain range bound for second quarter. When we move to housing finance companies, in this segment specifically, disbursements that are likely to remain strong, specifically for the players like Aavas and Aptus. In fact, when we look at some of the expectations, we are expecting, brokerages are expecting Aadhar Housing to remain a little bit of weak in terms of disbursements. But when we look at credit costs, that is likely to move down. We may see improvement in net interest margins as well. And at the same time, all these parameters, these will help these companies to expand their ROAs anywhere in the range of 0 to 20 basis point. Lastly, when we look at MFI segment, now this is something that we should be watching out for in terms of the asset quality, because in terms of disbursement, we are already expecting some kind of weakness here. And at the same time, when we look at credit costs, it is likely to remain higher. And at the same time, when we look at the return ratios as well, we may not see any kind of uptick here. But from here on, it is expected that this segment will reach its rock bottom, and that is the reason why we may see some kind of gradual pickup, and this will be because of the non-MFI diversification, new MFI guardrails that we have seen. We have already seen RBI also relaxing some of these guardrails, and at the same time, MFI cycle, which is expected to bottom out. All this can actually give a boost to the expectation going ahead. Now, when we look at gold financials, finally, we've already seen a huge rally in gold prices, and specifically when it comes to Muthoot Finance and Manappuram, we are expecting gold loans specifically to remain strong. In fact, for Manappuram, although the overall loan growth can be a little lower, but when it comes to gold segment, we may see this growing at around 20% even in FY26. When we look at some of the metrics, we may also see net interest margins to expand healthily for Muthoot and Manappuram both. And at the same time, when it comes to Muthoot, we are expecting to see around 25% ROE sustaining for FY26. And for Manappuram, profitability will also improve because of the provisioning in its MFI arm, which is coming down. So overall, when it comes to NBFCs, we are entering into a phase of selective resilience is what we can say, where we will be seeing a well-capitalized and secured lenders which are at a better place. And at the same time, growth is actually moderating, but at the same time, we will also see some kind of new upticks and new point of view in terms of the second half of FY26, which is expected to be better for NBFCs, not in terms of growth, but also in terms of margins?
Thank you, Gaurav, for joining in. We have with us Shweta Daptardar, Vice President, Diversified Financials at Elara Securities, joining in. Shweta, so just first big picture between the consumer retail financiers, the auto vehicle loan financiers, the gold financiers, and the housing. If you just break it up, or maybe we'll add the fifth one, MFI. If you break it up into these five, which is the segment you're most bullish on, where we will see growth and valuations are comfortable? And then we'll get to individual stocks and expectations.
Yeah, hi, good morning. Thank you for having me. So definitely gold financiers and mortgage lenders continue to dominate the overall credit growth and demand in the current scheme of things. Laggards is the biggest. Laggards have been still credit cards, where we have seen, although asset quality challenges receding, but moderation in or the softer trends in cards in force edition. However, having said that, we have seen certain green shoots now surfacing on the MFI and MSME credit. I mean, we would be certainly believing that second half looks very strong for MSME credit uptick. Also, personal loans pain cycle is fully behind. So we believe personal loans and MSME credit to sort of start looking up in second half of this fiscal. And largely the benefits are now flowing from the numerous tailwinds that we are seeing in the sector. So one is, of course, the domestic policy easing. I also believe another 25 bips rate cut is in offing before the calendar year end. So definitely the peak of consolidation or fiscal consolidation is behind. On net, the time is ripe for the credit demand to pick up. And I think that bodes really well for NBFCs, not to forget, of course, the GST simplifications.
Yeah, so Shweta, you called out two segments specifically, which you think will be really hot in the second half. You mentioned personal loans and MSME credit. So tell us the stocks as well, the NBFCs that are the best plays on this.
Yeah, so clearly two biggest tailwinds will be emerging in second half of the fiscal. We have seen bank rate card transmission now happening for the NBFCs, which is already in offing, Q2 numbers, whichever the companies have declared. We have seen interest cost materially coming down on sequential basis. So rate card benefits are flowing through. Juxtaposed to that, we have GST simplifications, which happened only at the fag end of the quarter. So those benefits will be fueling this consumption story. So definitely Bajaj Finance, L&T Finance, few of these smaller emerging mid-cap and smaller players in the MSME credit space should also start looking up. So yeah, net, it's a positive picture for the overall credit demand.
All right. Hi, Shweta. Good to hear your thoughts as always. On gold financiers, tell us how do you approach this space? Because, there are three notable players, so to call it. The large one is Muthoot, but that's trading at, I think, 3 times. You could correct me on that one, price to book. You have Manappuram, which could be the turnaround story with the new management in place, but that's at less than 2 times, I think so. And IIFL Finance as well has an element out there. How do you play this theme? And are you still confident about the largest name, which is Muthoot, or do you have a neutral rating?
Yes, Nigel. So we continue to maintain a positive stance on Muthoot Finance, and largely it's emanating from the fact that geopolitical upheavals continue to keep gold price on the higher side. I mean, of course, knocking off the near term or the latest volatility. Having said that, as you rightly pointed out, Muthoot is already trading at 3x plus kind of valuations, FY27 price to book. What we are advising here to the clients is, so Muthoot is clearly an accumulate on every dip or correction, if at all it's happening, because even as we move ahead next year, even if you factor in certain volatility in the underlying gold prices, Muthoot is poised to deliver 20% plus growth and 20% ROE. So that's pretty strong and pretty much justifiable as against the current expensive valuations. Coming to Manappuram and IIFL, yes, there is a turnaround story, both sort of surfacing for both of these names, but apparently that's been largely priced in. So Manappuram, particularly the new management, the strategy, the kitchen sinking, the execution will now determine the second leg of re-rating. For IIFL Finance, yes, the gold franchise is definitely picking up, but overall console ROEs I think those are still not yet there to the desirable levels. So clearly, Muthoot is a winner, and I think we will definitely see the stock rally sustaining for another 1 year or so.
Okay, all right. Shweta, thanks very much. Very helpful conversation. So it seems good times are rolling in for NBFCs as well as general demand for credit picks up. And of course, perhaps we have, slightly more generous RBI with a slightly looser policy in the coming months as well. Well, we're going to stay with the banking and financial services landscape. Like we pointed out, there's so much going on, so much of regulatory changes, including, of course, a whole host of new norms that were announced on Friday, draft regulations by the RBI. And let's not forget, Deal Street is buzzing. It's literally alive and kicking. And last week saw the culmination of another large transaction. Blackstone's picked up almost 10%, 9.9% stake in Federal Bank, marking another big investment in the financial sector, Indian financial sector. And this follows a string of deals. RBL Bank and Emirates NBD, then we have the Yes Bank deal, and even IDFC First, which managed to pick up private equity interest of late. So to decode what's fueling this excitement and this interest in Indian lenders, we have with us Amit Thawani, Managing Director and Head of Investment Banking at Nomura, India, and a veteran from the BFSI landscape, Mr. Rajneesh Kumar, former Chairman of State Bank of India. Gentlemen, thank you so much for joining in. Much needed perspective. Amit, if I could open with you, correct me if I'm wrong, I believe your team was involved in the deal. I know you won't get into deal specifics, but really, where is this interest coming in from? 6 months, 6 to 8 months, and a flurry of deals happening and lots of equity capital pouring into Indian banks.
So, firstly, thank you for having me on the show. You're right. The last, call it this first half of the fiscal, has seen a flurry of transactions, not only in banks in general, on financial services space, both from private or strategic capital providers as well as capital markets. Let's not forget, I think we had discussed earlier in the year that you will see a flurry of deals on the capital markets, and actually that's happened. Large IPOs, large placements, etc. We are at the cusp where, when you look at from a growth perspective, hopefully the growth is kicking off quite fast now. You are at a stage where Reserve Bank of India has been very proactive and been nice to the industry in terms of bringing in norms which can help in terms of credit creation. And you are at a stage where the Indian banking sector, both from a technology perspective, both from a balance sheet perspective, is very well poised to capture this growth. And thus obviously attracted attention both of private equity capital providers as well as strategic capital providers. Although each deal has its own reason and own rationale for having, so there's no particular trend that you can identify, and they all happen to happen at the same time. But each deal has its own reason why it's happened. But the core of the matter is that you have a very strong economy, you have a very strong banking and financial sector, and that's, raring to grow.
Is it also that you have cheap valuations? Because some are already making that argument. I'll tell you, Sandeep Tandon of Quant Mutual Fund was on the channel last week, and they're large shareholders in RBL Bank. Again, not getting into specifics of a deal, but the argument of an existing shareholder in that case was that, look, you should have sold at a higher price. So what do you have to say about the prices at which these deals are being discussed and negotiated?
Well, the risk reward looks in favor. Let me put it this way.
Okay. And are there more such deals in the pipeline? At the start of the year, you said we were at the cusp of foreign, investors or private equity getting into the Indian banking. 3 are done. But do you see more such deals?
As I said, each deal has a different rationale, but we're busy.
We're busy.
To say the least.
All right, let's get in Mr. Rajneesh Kumar as well, the former chairman of SBI who joins us on the show. Hi, Mr. Kumar. Good morning. Good to see you. What are you making of, this big infusion of money into a lot of these banks? How do you see things panning out? Right. It's not just positive for the banking names. It could be an industry tailwind as well. Please go ahead.
It is positive in the sense that it creates a reflection that the overseas investors, they have a positive outlook on the Indian banking sector and the Indian economy, and they see the growth opportunities. But we have to take a very balanced view. If you look at the market share of the foreign banks in India, it has declined. Actually, the kind of share they had before the economic reforms were ushered in the 90s, and the private sector banks came on the scene, it was public sector banks and some market share for the foreign banks. With the advent of private banks, the whole scenario changed and the market share minuscule. Many banks have left also the domestic market, like the latest example being of Citibank. So we should not go very gung-ho about it. But the fact of the matter is that there are certain banking institutions who are looking to have a foothold in Indian market. This could be their strategy to have presence in India. The most suitable segment in which these banks prefer is always wealth and personal banking, and wealth is growing in India. We know the middle class is growing, high net individuals are growing, and the wealth of the large section of Indian community is growing. So that makes it an attractive space. Competing in retail is always a tough task for any bank, whether it's even a large scale bank and operating in any jurisdiction, not to speak of India. So that is always a tough task. So to that extent, if these banks are taking a stake in a bank who have presence in retail, like we saw Yes Bank deal, RBL, earlier DBS acquired Lakshmi Vilas Bank. So it means that there are certain banking institutions who have interest in Indian market. But it's definitely a positive indication when it comes to the BFSI sector in India and the Indian economy as a whole.
Absolutely, sir. And you know what's also very interesting, that all these deals are happening without that critical aspect of voting rights, without that changing or without any chatter around it, at least that we've heard. And Amit, comment on this, that, what are you hearing? I mean, is that still a conversation that voting rights are capped at 26%? Should we still get in? Because people have come in irrespective. So do you see this as maybe a build-up to again lobbying for some change there?
It's been going on for 25 years. And, RBI, in its own wisdom, will be very calibrated, and it is a sensitive matter. I don't think we should read too much into the strategic deals happening, being a build-up into changes on the regulatory front. The regulator, in its sharpest wisdom, will do the right things for the country. It is sensitive, as one would expect. I don't think we should read too much into what's happened, resulting in any regulatory changes, etc.
Okay. There's also a lot of interest from Japanese players, right? I mean, actually interest from Middle Eastern players like Emirates we've seen. Then there is, there's names doing the round, Mitsubishi, UFJ. With the Yes Bank already we've seen Sumitomo, come through. Any particular color or take in terms of where all this foreign money is coming from and why?
So, Japan corridor or Asia corridor has been active. In the past also, you see SMFG buying Fullerton. That was a couple of $1 billion transactions, so pretty large. You've seen Korean players taking a minority stake in Credila. So the Asian corridor has been active, and I'd say will remain active. They have been players who have been in India for a long period of time. A lot of them have operations in some form and shape. So are now comfortable with the lay of the land. And you will see strategic inbound coming in from Asia. DBS itself did a large acquisition. And the Middle Eastern corridor is a great one to look at because India and Middle East share a lot of commonality in terms of business, in terms of capital flows, in terms of culture, and can be a natural partner into India. So it's a great trend to watch out into.
Do you think it's an opportune time now, Government of India, to go ahead and divest IDBI Bank? We've been hearing about this forever. I've just reading a note that's coming from Macquarie. From a stock market perspective, they hope Kotak Mahindra Bank doesn't do it. They believe it's a de-rating event. That argument for another day. But do you think it's made government's job easier? It's an opportune time to go ahead and divest a bank that they've been talking about for the last 2-3 years.
See, it's a very strategic divestment. Let's not oversimplify it. It's a large bank.
Yeah.
And the government is doing the right things in terms of engaging with strategic players very deeply. Timing is a question of appetite in the market, which it is there.
Question for Mr. Rajneesh Kumar. Sir, while we take your point completely that the lay of the land when it comes to personal banking here in India, retail banking, is not easy. But would it be fair to say that perhaps for Tier 2 or Tier 3 PSU banks or even Tier 2, Tier 3 private sector banks, the competitive intensity is going to heat up because you have all this foreign capital coming in. And look at the Federal Bank press release. I mean, it goes on to categorically say that their ambition is to become the 5th largest bank in India. So what will change in terms of just the day-to-day operations over the next couple of months and quarters with this heightened foreign interest?
So when there is a competition market, you and I should smile because more competition means more benefit to the consumer.
Sure.
And again, I'm repeating the same point that if the banking reforms were not carried out in 90s and private sector banks would have come in, there would have been no competition and then there would have been no desire to improve the consumer experience or these services. So competition is good and we have a very good regulatory environment in the country. So I think as a consumer, we all will benefit.
But what does it mean? I mean, will it mean, sir, perhaps the need to raise capital? Again, I'm talking about tier 2, tier 3 banks, PSUs, as well as private. Will they have to shore up their capital buffers? There's going to be fight for market share. So what does it mean in terms of business?
So it is all about the business strategy of a particular bank and the capital management, an efficient management of the capital. That itself requires a lot of attention from the board and the management. Capital is available, but is available only when that capital provider believes that you will be able to generate the returns commensurate to the expectation of the capital provider. In case of the government ownership, that is not as prominent because the public sector banks, they are to do certain businesses where it's not always driven by the commercial interest or the profit. So there is a different set of banks. You have public sector banks, they have the obligation to generate a decent return and perform well. But at the same time, they have obligations which are not necessarily very profitable, but they are bound to do it. It is their mandate. It is the desire of the government who owns the majority. The private capital or the private banks, it will always be returned to the shareholders. And in that sense, it's not a level playing field fully. Third is foreign capital or the foreign-owned banks, and their business strategy and the return on capital expectations are different. So we have 3 different set of people, 3 different targets or business strategies and the market segment in which they operate. Foreign banks will mostly operate in wholesale.
Okay. I think we just lost that line with Mr. Kumar. But he was saying that, strategies will evolve and it's large markets. So perhaps there'll be segmentation in any case. Amit, thank you so much. Very helpful conversation. And we heard you saying it's continuing to be busy. It'll probably be busy and there are more to come. So we'll watch out for that. Thanks for joining us today.
Thank you very much.
Program.
Thank you.
Okay, we take a very quick break. Come back with an update on the commodity markets in just a bit.
Welcome back. Let's talk commodities now. Manisha is joining in, and it's copper on her mind right now. Manisha.
Thank you for that, Rima. Well, it is because that is the reason copper is trading at an all-time highs, near all-time highs right now. If you look at the copper prices, we've gained up by nearly 25% in this year till time. The all-time high that copper has seen on LME has been in May 2024 at the tune of $11,104 a ton. Currently, we are trading at around 11,000. It seems to be really gyrating around those levels. But the point being that we've seen 11,060 in the markets on Friday. So that tells you that we're not too far away from its all-time highs. And as I said, copper has gained up by nearly 25% in this year until time. Well, there have been various supportive factors to begin with. It has been about the decline in US dollar index in sense of macros. And then the US and China meeting this week could result in a trade breakthrough. All the statements that we've been hearing over the weekend have been quite supportive. You have threat of 100% US tariff on China now off the table, as Secretary Bessent has said. And then Beijing also is expected to pause for a year its rare earth export control. So both sides seem to be working towards something. Remember, they are the largest consumer countries, and China, of course, is important in sense of producer and consumption as well. But apart from that, it is about mining concerns, which seems to be keeping copper on the higher side. To begin with, it's about Codelco's El Tenite mine in Chile, which has seen some disruptions coming in. It also has to do with major sites in Dominican Republic, which have seen some electrical issues, and that is the reason the mines there as well have seen some shutdowns. Democratic Republic of Congo also is looking at some mining concerns there. And then you have the Grasberg mine in Indonesia, the accident therein, and we haven't seen much of that still come on form. The expectations are that the Freeport mine could be looking at all of its production coming in only by the mid-2026 or even 27 for that matter. That is what is keeping the copper prices higher. As you can see on MCX as well, we're looking at 1,000 rupees a kg right now. So very, very strong gains coming in for this one. There also is a report from BHP which says that there is going to be a lot of decline that you're looking at in sense of global demand by 2050, and that would be driven by energy transition. Also, the markets will watch out for the central bank meetings this week. You have US Fed meeting where expectation of a 25 basis point of a rate cut pretty much has been factored in by the markets. And then you have European Central Bank and Bank of Japan monetary policy meetings also this week. So lots of event and data coming in. But the street does believe that by the time we close this year, you could be looking at 11,001 taken off. So that means new higher highs coming in for copper pretty soon.
Thank you very much for that. Get into a break. On the other side is our special segment, Indonomics. Lata speaks to veteran bankers Zareen Daruwala, former MD Standard Chartered, and Srini Varadarajan on RBI allowing banks to do acquisition finance and on the new foreign banks' interest to buy shares of Indian banks.
Welcome to Ideonomics. We stick with banks. The ecosystem for banks is getting more dynamic. In the past 6 months, 2 foreign banks and 1 private equity have bought stakes in Indian banks for nearly 50,000 crore rupees. I'm referring to, of course, the NBD in RBL, SMBC Bank in Yes Bank, and Blackstone more recently in Federal. Separately, the Reserve Bank is removing old constraints on Indian banks. For the last 2 decades, Reserve Bank had insisted banks should only lend for capex, that is, create fresh assets, not to help corporates buy one another's assets. Now the Reserve Bank has announced draft rules allowing banks to do acquisition financing. More generally, ECB financing rules have also been eased. Does all this mean more business for banks and more competition? Will more foreign banks be attracted to India? Joining me to discuss whether we are on the threshold of a brave new banking in India, or at least an inflection point in Indian banking, are 2 veterans, Zareen Darwala, former CEO and Managing Director of Standard Chartered Bank, and Srini Varadarajan, another veteran banker who has done stints in Axis as DMD, before that in ICICI, where he probably worked with Zareen and was in the capital markets division along with JP Morgan. Zareen and Srini, thank you very much indeed for your time. Zareen, for starters, we saw Stanchart and Citi actually reduce their businesses in India. But now we have 2 banks from different geographies, Japan and Middle East, coming in to buy huge stakes in small Indian banks. Will we see more of this?
So first of all, Lata, I don't think Stanchart reduced its business in India. I'll clarify.
Okay.
It globally decided to exit unsecured lending, and that was a global decision. Otherwise, very much a large presence.
Okay.
Coming to, after SMBC and NBD, will more foreign banks buy? Yes, absolutely. I feel banking is a good barometer for the Indian economy, and we will see a lot of the smaller private sector banks which need more capital, certainly looking at this optionality. Also, I think the segment that we will see more attention coming in a few years is the small finance banks. Clearly, there will be some consolidation that may come through in that segment. And I think the last 2-3 deals are also a sort of reflection of the good geopolitical relationships in India-Japan corridor, UAE-India corridor, and the whole business momentum in these corridors will pick up, which will help these banks in their business in India. And I feel there'll be a trickle of strategic stakes, not a flood.
Oh, okay, trickle. Well, a similar question to you, Srini. On the one hand is the foreign interest, which, of course, will have to go through this voting rights issue as well. But separately, how many Indian promoters will be willing, sellers, or I'm only referring to banks now, will they be willing to give up a strategic stake to banks?
Yeah, I think if you look at the shareholding of banks, and what RBI tries to achieve is to have a diversified shareholding. And to that extent, you do not have any large shareholder as such in a bank, other than barring a couple of banks right now. So the opportunity for someone to take, and therefore most of these banks are professionally run. And therefore the opportunity for a financial investor or a strategic investor to come in and take a reasonably large chunk, which is broadly around 10%, and in some cases, as we're seeing, where RBI is slightly more liberal, to more strategic stake, where a controlling stake is also happening. I think it's possible, but I don't think so there's any sponsor looking to sell. It is just banks clearly have need for capital, and that capital requirements can be met through incremental issuance to existing investors and domestic investors. But again, if there a strategic comes in and they believe have deep pockets, I think it's useful for the bank from a growth point of view to try and get those investors on board. And I think that's what we're seeing that's happening.
Okay. Well, Yes and RBL Yes has the advantage of being a digital bank. It's a new bank. And RBL has reasonable branches, not many. But, will the ROI be justified for, any global bank? Srini, you go first on that.
Yeah, I think if you look at the geographies from which these investments are coming from, I think these are really cash-rich geographies, and they are seeking long-term investment. And the threshold returns, which possibly they're expecting, is more related to the growth in these entities rather than actual return on equity, which possibly will happen over a period of time. It gives them access to a market and customers which continue to grow, and the visibility of growth is very high. And they will ride the wave through the cycles. And I think that's the way I think both the RBL and the yes transactions have happened. In Federal Bank, I think it's more a financial transaction. I think it's a good, well-run bank, and therefore nothing changes from the way the bank runs, and it's a financial investor coming on board.
Yes, it's only a private equity. It's not a bank. But Zareen, you said that you don't see a flood but a trickle. I mean, it is a long way to build a retail interest in Indian banks, and the giants are already there. The top 5 banks are really big in India. So is that what is making you a little skeptical that foreign capital may not rush in?
No, I think the number of entities which are available or platforms is not that many for a foreign bank to come and, if you take the next tier of banks, they are quite small, some of them like Karnataka, Karur Vyasa, right?
Yeah.
And it's quite possible that some of those entities may not be very exciting for foreign banks.
Okay.
While RBL and Yes were much bigger banks, in the Indian scheme of things. Having said that, if a bank is very keen to have a ready-made platform, then yes, it provides a ready-made platform. But then culture-wise, it becomes a challenge for the foreign bank also sometimes, to sort of revitalize the culture, which is suited to global aspirations.
Yeah, I think in Federal Bank, the advantage was that they got a stand-chart banker for a good 15 years. And then perhaps even now, it's only a private equity capital. Okay, Srini, time permitting, I'll return to this. But basically, you also agree that there could be a flood of capital.
I agree with Zareen. There's got to be no flood of capital. I think the thing is the visibility of growth is there, and therefore people are interested to invest for the long term or strategic perspective.
So more private equity than banks?
But as you said, I think the return expectations need to be moderate. I don't think so you can expect exciting returns or blockbuster returns from these things in a 3 to 5 year period. It's a long haul. I think foreign banks have struggled in the Indian context, as you said. The top Indian banks have given the foreign banks a run of their money, and clearly building a business here, both wholesale and corporate, both wholesale and retail, has not been easy for foreign banks. So I think it's more having a foothold in a market which is growing and trying to find your way rather than trying to say, I'm going to get exciting returns here.
Okay, fine. Time permitting, I'll return to this. The bigger, excitement for the entire Indian banking sector is the draft rules on providing money for acquisitions. Until now, banks could not do that. They will start from April 2026. Now, the rules are that the banks have to, the limit is 10% of their tier 1 capital for the entire banking system. That comes to about 4 to 5 trillion rupees, not a small amount. And the rules also are that it should be a profit-making bank. It should be a profit-making company whom they are financing, listed and profit-making for 3 years. Zareen, is this opening up a big line of business for Indian banks?
I would say it is definitely a segment which for many years has been close to Indian banks. And to a large extent, most of the M&As were getting funded from FPI or NBFC or AIFs. To that extent, it's clearly an area of opportunity for Indian banks to sort of step in. Having said that, as you rightly said, there are boundary conditions like debt equity ratio of 70-30. Similarly, the acquiring company has to be a listed entity. So there are boundary conditions, and also it eats into the CME exposure of banks, which is not a big headroom that banks have. A lot of banks have, CME exposure is sort of not that much headroom is available. To that extent, it is a new area and it's an opportunity for Indian banks.
Okay. Your thoughts, Srini? It's not just these constraints. Also, as Zareen pointed out, the overall 40% of Tier 1 remains as a cap for all capital market exposure. Will banks be interested? Banks have not shown much penchant for corporate lending itself.
Yeah, I agree that I think, again, here also one should moderate the excitement in terms of what investors and outside stakeholders think about what the RBI regulations will achieve as far as the banking sector is concerned. If you look at the tier 1 equity of banks, broadly it's around 25 lakh crores. So if you look at 10% of that, it's about 2.5 to 3 lakh crores is what you will get.
Okay.
This is a limit which is not going to increase over the next at least 3 to 5 years. And if you look at any bank, I don't think so they're going to achieve 10% in 1 year. So if you assume they're going to achieve this 10% over 3 to 5 years, and you're talking about 50,000 crores.
Okay.
And similarly, as you said, that ICICI, HDFC Bank and SBI are almost 45 to 50% of the banking sector net worth. Yeah. So almost if you're 2.5 lakh crores, 1.25 lakh crores is with these guys. So the whole thing is, if one of these guys don't show much interest because other capital market exposures offer them much better returns, the amount of banks financing which can happen for this is much lower. So I would think it's a window which is open for exception trades to happen, meaning some trades will go through where listed entities which are acquiring good targets, I think, and highly rated will get financing. But to believe that every acquisition is going to be financed by banks, I think it's far away. I don't think so business of NBFCs and IIFs are anyway going to be affected by this. I think they play in a different segment. Sponsor financing is a big part of that. And any acquisition debt, typically good corporates find a way to finance it through entities which offer almost slightly higher than debt financing rates. So sponsor financing is unaffected, and I think banks will slowly scale up. So I don't think so one should expect immediate growth from this. It will be a good start.
Okay. Well, thanks for pouring some cold water into, enthusiasm of the naive. Zareen, what's your take on this? Would you say that, this 3-year listing and 3-year profit should go? I mean, that will reduce the terrain so much. Do these guys, 3 years profit making and listed stocks, even want bank money?
No, so I think, sorry, I didn't get your question.
No, see, the rules are that you can finance acquisition only if the acquirer is a listed company and has 3 years of profit-making record. Such people will not even want money, no, they will have their own money. So do you think this is too restricting a qualification?
I think most M&As, there is some funding because even if a company has surplus cash flow, they may have commitments for capex, etc. So they do come to the market. There are very few who are zero debt companies like the tech companies or some of the MNCs who don't come for borrowing. So to that extent, I would say even if they're listed and they're profit making, they will access bank finance stroke NBFC finance for acquisitions.
Okay. Well, I'm not done with my questions. There is another set of
Lata, I just want to add one thing. I think the way I'm looking at how RBI has changed its mindset here is that till now you are trying to tighten NBFC regulations to make it on par with banks. Now it's happening the other way, where RBI is saying, I will relax banking regulations to make it on par with NBFCs. So that process is starting, where you're trying to level the playing field. You level the playing field from one side. Now you're saying from the other side, I will level it.
Okay.
So we will get to somewhere in between.
Okay, that is actually a headline. Yeah, Zareen?
I'd just like to say that what Srini said, this is a new lane which is created, not an autobahn.
Okay. Anyway, that's still important. Let's hope that the lanes will be expanded as Bombay is doing or as India is doing. Lanes will get expanded into multiple lanes. We have to take a break, but I'm not done with questions. There is this ECB financing also which has been relaxed. And I wanted your views on, the entire banking sector impact of this complex of rules and this change of